everyone, and welcome to this special year-end edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. It's been a fascinating year, 2022. It's been a challenge for many investors, and if you've struggled as an individual investor, as a financial advisor, as an institutional investor, you are not alone. People in all of those different cohorts of investors have struggled. These are challenging times. The good news is, if there's something to make you feel better about 2022, regardless of what your P&L or what your returns have been, is that I have found in my career that I've learned way more in bear market phases than in bull market phases. And it's not even close. Bear markets are where, bull markets really are where you can develop a lot of bad habits, and it really doesn't matter that much, right? You can get away with making bad decisions sometimes. You can get away with not spending your time wisely. You can get away with consuming information you probably don't really need and maybe using it not in the most appropriate way, only because the market overall is appreciating. And so you can get away with it, right? You can sort of benefit from the fact that a rising tide lifts all boats. Bear market phases are more challenging. That's where risk management really comes in. If you don't have a good risk management game in place, it's easy to get away with that in a bull market. It is really hard to survive a bear market without really good stop loss strategies, really good money management skills, really good thoughts about diversification or focusing your portfolio thoughtfully. And so I found bear markets are really, really good learning experiences, good educational moments, and later down the road in your career, you'll probably look back at 2022, hopefully, as one of those opportunities to learn and to grow as an investor. The first two charts we talked about so far this week, the first one was the S&P 500. Think about the long-term plays from the 2020 low to the 2022 high, using Fibonacci analysis, some other tools to really think about the overall framework of the markets going into next year. On day two, we talked about interest rates, talked about the $ TNX, which is the 10-year treasury yield, some of the different ways to think about the shape of the yield curve, what rising and falling rates tend to mean for different areas of the market, particularly leadership themes and equities, which I think have been, in a lot of ways, the story of 2022. Today, we're going to look a little bit outside the equity space and think about three different really four different charts in one that talk about how equities are related to other asset classes. John Murphy is our chief technical analyst, really in an emeritus role, and helped really grow StockCharts from its early days with our founder, Chip Anderson. A lot of our site is inspired and driven in many ways on John's work in his time on financial television, on CNBC and elsewhere, but also writing some of the most seminal works in technical analysis. First book I ever read was John Murphy's Technical Analysis of the Financial Markets. So John actually did a lot of great work on intermarket analysis, as did Martin Pring, who's one of our contributors now. Intermarket analysis is basically, from my definition, the process of looking at how different assets are related: stocks versus bonds versus commodities versus currencies. And what I will tell you as we look at this chart of the dollar and crude oil and gold is that we often like to think very simplistically about these relationships, right? If stocks are going higher, gold is probably going down because gold is more of a safe haven. If stocks are struggling, gold is probably going up because gold's a safe haven, right? It's where people would probably go. Gold is a good inflation hedge. Crude oil tells you about, can fuel all sorts of things like consumer behavior and airlines and all sorts of things like that. The dollar has different things. Is the dollar a sign, a strong dollar, good or bad for stocks? And all of those things that I just posed are fluid. And I think that's the reality. When I was learning this first in the early 2000s, I remember drawing a very simplistic diagram. If the dollar is going up, that means commodities are going down. Commodities are going down, that means bond prices are going up. Bond prices going up, that means rates are going down. Or rates are going down, that means stocks are going up. And I remember drawing this like flow chart. And I remember thinking, as I read it out of some book, like, all right, easy. All I need to do is remember this diagram and I got it figured out. And the reality is, that is true for a very particular set of conditions in the financial markets. When you have inflationary pressures, when you have the Fed adding or withdrawing liquidity from the markets, when you have a once in a generation crisis like the COVID crisis, when you have geopolitical issues, all of those things really show how unstable those relationships are. They're not as consistent as we probably like, and we'd love for them to be consistent. Bob Prechter, who I heard present on this years ago at a behavioral finance conference, and he basically said, All right, here's an example of where the dollar and gold move against each other. That's the relationship we'd expect. All right, here are a bunch of examples where they move together. All right, here's where stocks and bonds move together. Here's where they don't. And so it was pointing out the fact that those are fluid relationships, and understanding the interplay of those relationships and how they play out is really key, right? And understanding that they're not static relationships. But for me, it also has reminded me over my career. And again, I started in the industry in June of 2000. So as I'm looking back at what I've learned through a series of bear market experiences and a series of crises and a series of bubbles and bullish and bearish cycles, I will tell you that if there's one thing I've learned is that the reasons as to why relationships change often become very clear way down the road, right? Looking back and writing a book about the financial crisis, it seems very straightforward, all of these causes, how they interplayed, the timing of how it played out. But I will tell you, having gone through that, as an investor, it was very confusing. It was very challenging. I remember debating with people, can there be a V bottom? Can the market rally without financials? Is the market going to zero? Are we retesting the 2001 low, 2002 lows? Those are the kind of debates you have in the heat of the moment because it's unclear. Later, the reasons and the relationships make sense. So it's a great, I think when you think about intermarket analysis, for me, it's a reminder that the chart is the most important thing to watch, because while the relationships can change and the cause and effect can change, certainly at times, the price is not changeable, right? We can't restate the price. It's not like down the road we can look back and say, no, actually gold was in a downtrend that time, and that's why it makes sense. Gold is doing what gold is doing. And so understanding the relationships, I think, are a process, a discussion you have after you understand the charts and you understand the trends and you understand the momentum and you anticipate the inflection points. That was my long-winded introduction to chart 3 of my top 5 charts of 2022, which is really thinking about non-equity asset classes and thinking about that relationship back to stock. So we have 4 series on this chart. I'll talk through them from top to bottom. At the top, we have the dollar index, which on our platform is $USD. This is a weighted dollar versus trade partners of the U.S. And there are a number of different dollar indexes. This is the most common one. I've seen it as $USD, $DXY or DXY or something like that on other platforms. But this is sort of the classic dollar index. The second series down is a relative performance chart, a ratio between the SPY, the S&P 500, and ACWX or ACWI XUS. So ACWI is a broad global benchmark. So the S&P is sort of a broad U.S. benchmark. ACWI, All Country World Index, is a broad global market. It includes U.S., global developed stocks, and global emerging stocks all in one big index. Generally speaking, I think of it as about half, 50% U.S., 50% non-U.S. And so the U.S. is, by far the biggest weight economically or I guess weighting wise in the portfolio. So this particular ETF, ACWI, is an ETF that tracks that index. ACWX is an ETF that tracks an index of ACWI XUS. So it's basically there's 50% US, 50% non-US. We ignore the US part and we're just looking at the outside the US portion. So this ratio is basically, if this line is going up, the US is outperforming everything else. If the line is going down, everything else is outperforming the US, or the US is underperforming. Further down, and then we'll talk about some of the patterns that we saw through the course of the year. Further down is crude oil here in this brownish color. And then at the bottom, and that's just the crude oil future, the continuous contracts. We're following the front contract in the futures market every time it rolls over. And then gold is the continuous contract here. And again, following the front month of gold future going back. That's $GULD. Crude oil is $WTIC. By the way, to construct this chart, just a StockCharts 101 kind of tip, you can do a lot of things to kind of make this chart look different ways, and all of those settings are below the chart. And if you put, when you say an indicator price, which basically just puts the the price of something below as a panel below, and put the ticker comma log, that actually puts a log scale. And when you're looking at longer term charts, I would say 99% of the time, you probably want a log scale chart, if not 100%, because that is a way of looking at charts on a consistent percentage basis instead of a consistent dollar basis. What happens is if you ignore logs charts, the semi-log scale, then the vertical axis becomes compressed at lower values and exaggerated at higher values, when in reality, a chart that has had a continued percent return would look kind of like a hockey stick, right? And that's that's not really accurately showing the evolution of that trend over time, is how I would describe it. So we're looking at all of these on a log scale, and this is a ratio, so you don't really need to use a log scale because it's a percent. It's looking at a percent difference between two things. So log scale doesn't really mean much there. So what can we take away from this chart? So number one, remember in 2021, the dollar, was moving higher, but not dramatically so, right? It was sort of in a nice slow and steady uptrend. In 2022, we've talked so much through the course of this year about how there has been a change of character, right? The market in 22 looks very different than the market in 21. For so many reasons, arguably the Fed as a big part of that, the Fed, sort of addressing the inflationary issues that we've seen thus far. So you can see that the dollar index really accelerated to the upside, peaking out here in late September. From late September, we had sort of a series of lower peaks, and then we broke down. And in the last 6 to 8 weeks, you've actually seen the dollar in a pretty consistent downtrend. Really, for the last quarter since late September, you've seen the dollar in a pretty good downtrend. Now, the stronger dollar does a number of different things, and this first series below shows you one of those things, right? Stronger dollar tends to mean U.S. stocks are going to outpace global stocks, non-U.S. stocks, because of the currency differential. Think about it as a U.S.-based investor, right? Let's say the Indian market, which has been one of the better, non-U.S. markets, probably up until the last couple months. If you've looked at the performance of the Sensex or the Nifty, which are the major Indian benchmarks, if you look at the performance of those indexes, at or near new all-time highs in the fall, breaking out a lot of individual Indian stocks looking very, very good. But the problem is, as a U.S.-based investor, the returns you get from the Indian stocks are deteriorated when you convert those Indian returns in rupees back into U.S. dollars. As an example of that, look at INDA, which is a U.S.-listed India ETF from iShares. Look at the relationship between the Sensex making new highs and INDA, which is nowhere near its new highs, and that is essentially the currency differential. When you convert the Indian gains back into U.S. dollars, it deteriorates a lot. So you're making money on the stocks, but you're losing it right back based on the currency differential. So when the dollar index is going up, it's not a great environment as a U.S.-based investor to look outside the U.S. because you have to have so much greater returns to justify them, right? To sort of beat the currency loss that you're going to have by converting your returns back to dollars. So look at how that changed, right? You can see the purple line with fits and starts, right? With some movements, but overall, when the dollar's going higher, this ratio is going higher. When the dollar comes back or stabilizes, you'd see the ratio go lower a little bit. Look at how the ratio accelerated to a peak in late October as the dollar was really strengthening going into the fourth quarter. From there, though, look how for November and December, and we're recording this in mid-December, you can see how this ratio has gone down. What that means is that non-U.S. stocks, non-U.S. ETFs, all of a sudden have a tailwind to their returns as opposed to a headwind if you're a U.S.-based investor. So all of a sudden the charts of the UK, France, Spain, Italy, Germany, all of a sudden starting to look more attractive. Even some Asian markets like Japan had been in pretty good downtrends, starting to rotate higher in a pretty good way. And while there's certainly strength in those markets at times, it's the currency difference that is making such a big change there. Also, the dollar has a lot to do with risk, right? So the dollar going higher is sort of a flight to safety globally, right? So investors go to park their money in U.S. assets, in U.S. dollar denominated assets in times of instability, generally speaking. So the stronger dollar in 2022, we've called it the wrecking ball for risk assets because average week in 2022 was the dollar up, stocks down, bonds down, commodities down, right? Generally, like average week, that's pretty much what we saw, right? Sort of a defensive feel to the tape, again, with some notable mean reversion there with a couple of bear market rallies. But overall, that was sort of the trend. And you can see how it was sort of strong. If you look at the trends year to date, the dollar outpacing most things in 2022. Up until October, November, and early December, when all of a sudden that changed a great deal, right? The dollar went from making new highs to making lower highs. And all of a sudden that coincided with the S&P making its low in October. All of a sudden the dollar pulls back, allows stocks and bonds to both go higher. This is where the 10-year yield goes from 4.25 down to around 3.5, which is about where we're at right now in mid-December. All of that arguably is connected to this dollar chart. The reason why I'm spending so much time on that is because I think going forward, the big question, or one of those big questions on my mind, is whether this was a mean reversion move in the last 2 months and you see a move higher in the dollar? And if so, that would set up for a lot of pain for stocks in the first quarter. It would also suggest that those spikes we've seen in non-US markets versus US markets might be an aberration, a short-term aberration. And then once we go back to sort of the norm, which is stronger dollar, that would probably hurt non-US returns versus US returns. That's what I'm actually expecting. I think that's a more likely scenario than the top is in and the dollar is just going to weaken from here and risk assets can rip to the upside. And that's tied to what the Fed has told us very clearly that they're planning to do over the next 3 to 6 months, which is continue to raise rates, continue to be very restrictive, continue to try to bring economic growth down, to bring inflation down. And that most likely leads to a dollar pushing higher here. The other two shares I would highlight would be crude oil and gold, and because, again, they're all related. Now, they are not one-to-one related. So just on this chart, looking at the last couple of years, you can see times when stocks move higher and crude oil moves higher. You can see times when stocks move lower and crude oil moves higher. You can see times when crude oil moves higher and stocks move lower. And I'm highlighting, as I'm looking, I'm just glancing around the chart and I'm looking for those different relationships. Same can be said for gold. What's interesting about these last two charts, by the way, a couple things. So crude oil, look at how closely crude oil and gold have matched each other for quite some time right now. For most of 2021, commodities as a whole had a pretty good first quarter. From there, pretty consistent downtrend. The relationship sort of changed here in October. Look at how the dollar is making a lower high, crude oil and gold making a higher low. And I remember at this time in mid-October, I remember telling my viewers, looks like commodities were sort of beginning this next big move higher. That means energy material stocks probably in a pretty good shape. The dollar coming off means more risk on of a feel. This could be a nice time for stocks. And the risk on feel weaker dollar certainly played out. Gold moving higher appeared to work pretty well, but crude oil, look at how that changed, right? So instead of gold and oil moving together, all of a sudden crude oil moving lower, and gold moving higher. What's so interesting about the chart of gold, by the way, is if you had told me at the end of 2021, equities are going to be in a bear market, bonds are going to be in a bear market, inflation is going to be the number one concern on everyone's mind, what should I do? My answer 10 times out of 10 would be buy gold. Because if you look back in history, gold has been pretty much the inflation hedge, right? It's been one of the best places to park when inflation is an issue and when risk assets are struggling. That's how gold has gotten its sort of name as a safe haven. Did not happen. And again, that's related to the dollar being so strong. Gold is denominated in dollars. So you have the denominator going up so much. Gold is not going to make upside progress in that environment. The dollar coming down has allowed gold prices to appreciate and start to improve a little bit. So another question going into to the new year is we've seen a lot of improvement in the gold space. Gold has gone from lower lows to higher lows. And the question is, can you get a sustained move higher in gold? Gold stocks, things like Newmont Mining's, Agnico Mines, Kinross, all of these other Royal Gold, all of these have been charts which have been struggling for much of 2022, really starting to improve here in the last couple months. Is that going to be a phase that continues on into the new year? I like, from a technical perspective, again, we can debate what may happen, and I'm concerned about the probability, the high probability of the dollar resuming an uptrend and once again muting the returns of other risk assets. And I think that's very much an issue that is likely. There's another scenario where gold actually does okay, and there's a risk-off move that is a more of a gold-friendly risk-off move, and these breakouts that we've seen in gold actually can sustain. And charts like Newmont and others, if they do pull back, find support and are able to rotate higher. The good news is, as a technically oriented investor, you don't have to guess what's going to happen. You don't have to know with a crystal ball what's going to happen. You need to analyze the trends, think about the probabilities, and position yourself for what you think is the optimal scenario, but also plan for risk. I did a webcast in mid-December here about risk management, particularly stops. So if you've not gotten familiar or comfortable with setting good stop losses so far in 2022, I hope that is my hope for you in this holiday season into the new year, is you find a new inspiration to more clearly define your downside risk using stops, because all large losses begin as small losses. So this is chart number 3 of the top 5 charts of 2022, the US dollar, really thinking about the dollar index and how it's related to other things, right? How that impacts US versus non-US returns and how that really played out in 2022, the relationship to the commodity space with crude oil and gold, and some of the ideas of where these assets may be headed in the new year. For StockCharts.com, I'm Dave Keller. Have a great holiday season. We'll continue on with the 4th and 5th top charts of 2022 through the remainder of this week, and we'll see you again soon. Bye now.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.